if you hit around 80 to 85% passive, you will automatically guarantee that you are going to have an XIV type event for the S&P 500. We're talking about a $70 trillion market that could theoretically end up going to zero. The U.S. government will be forced into extraordinary measures, including most likely closing the market.
Michael Green has a warning about passive investing. The chief strategist at Simplify Asset Management says it's creating serious systemic risk in the markets. The billion-dollar fund manager used to manage Peter Thiel's personal capital. Before that, he was at a hedge fund seeded by Soros Fund Management.
Ultimately, my theories of markets are around flows, and so what I'm interested in is what is going to precipitate a change in flows.
Programmatic buying, if you will. You're basically saying there's a point at which that reverses. You referenced what's going on in the gold and silver market. I wonder if you can use those as examples. You had this stat that smacked me in the face. In 15 years, half of the boomers will have passed on.
Yeah.
When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On this episode, we've got Michael Green of Simplify Asset Management, who is a really interesting character. He has spent decades in the market alongside some investing legends, seeded by Soros Fund Management, worked with Peter Thiel, he name drops David Einhorn, but more and more he's spending less and less of his time in the weeds with specific stocks. So we're going to do something a little bit different on today's episode. We're going to talk about the structure of the market and the growth of passive investing. And he talks about how passive investing could be becoming the next systemic risk for the S&P 500. He's not saying it's a bad strategy, but rather that if too many people do it, it risks an accident in the markets. And by the way, he's profited from one of those accidents, and he tells a story about actually taking a position on an ETF that ultimately went bust, that he didn't think was set up properly, and he proved out to be correct. So it's a really fascinating interview with a guy who really thinks high level, not just about how the markets are structured, but how the world is working. He's got this view on demographics and how that flows into commodities as well. There's certain commodities he would not touch. It might surprise you. So let's get into it. Michael Green, thank you so much for joining me on the podcast.
It's a pleasure to be here, Amber. Thank you for having me.
You have kind of built up this reputation as the passive investing guy, or I guess more accurately, the anti-passive investing guy. And I wonder if, just for people who are unfamiliar, you're also an investor, but you've taken on, a cause, almost a campaign, really trying to warn people about the perils of passive investing.
Well, first of all, thank you for that. Yes, I am an investor. I'm the chief strategist and a portfolio manager at a firm called Simplify Asset Management. We're about a $12.5, almost $13 billion firm, and I directly manage one of our funds, the high yield fund, as well as participate in the management of several others. It's not that I'm so much anti-passive investing. I often get that sobriquet. There's been articles written about me calling me the Cassandra of passive investing. I want to remind people that Cassandra's curse was that she was right, but people did not heed her advice. And that's part of the reality. I don't anticipate that I'm going to be able to stop people from investing passively. In fact, one of the things that I just try to convey is educate people on how much of the market phenomenon that we're seeing today is a byproduct of the overwhelming growth and allocation of assets into passive index strategies. So, it falls into the famous aphorism, what the wise man does at the beginning, the fool does at the end. The idea behind passive investing was very straightforward, that ultimately the markets were largely efficient and therefore prices largely reflected all of the best available information that could be obtained. And as a result, if you simply invested in the same proportion as market capitalization, i.e. mimicking the aggregate decisions of everybody else, that you would be the beneficiary of that knowledge that people were adding, that information that people were adding to the stock market or to a bond market, et cetera. The problem is that the theoretical framing for a passive investment strategy relies on markets being highly elastic, meaning they can absorb effectively any quantity of inflows without significant changes to price. In particular, the efficient market hypothesis uses a model in which $1 into the stock market, because there is a seller on the other side, the only change in market capitalization would effectively be the bid-ask spread. So basically, $1 in creates about 1 penny of incremental market capitalization. The problem is we now know that's not true. We know that markets are actually highly inelastic. We know that the number is roughly around $8 of market capitalization that is created every time a new dollar enters the market. The reason for that is that sellers may be less willing to sell at current prices. That's a form of inelasticity that actually causes prices to rise by much more. And so the specification of the efficient market hypothesis on which passive investing is based is off by roughly 800 to 1.
Just a small rounding error.
Like to joke, that's not even good enough for government work. The second issue is the scale of the activity. And so passive investing has largely replaced active investing, and that's particularly true in the marginal investment dollar. So as of today, as of last year in 2025, there was about $600 billion worth of outflows coming from active managers and about $1 trillion that flowed into passive vehicles. That unfortunately amplifies many of the trends that we're seeing because those two behave in very different fashions. In general, active managers skew towards a value bias. They're attempting to discern what the forward price of the stock should be based on its fundamentals. They are discounting that back and using that measure of value to help select stocks that are trading below that fair value, hoping to earn excess return in the process. Passive investing buys in proportion to market capitalization, and the next dollar in buys in proportion to the market capitalization that happens then. In other words, stocks that rise in market capitalization will receive an increased allocation from the next dollar in. This is reinforcing momentum trends, and the outflows from the active managers focused on valuation is basically causing the market to behave with an anti-value framework that's contributing to rising valuations and the perceptions that the market is largely a Costanza market. Take the most logical, thoughtful thing that you would do and do the exact opposite of it. This is a byproduct of the growth of passive investing.
And you understand the behavior of investors because active funds are more expensive and on average, they underperform the market, and you've got an inexpensive way to access the market that can reliably over time grow around 10% per year. So, when I'm listening to you, it's not like you're saying that's a bad strategy. It's just like if everybody does that, you actually could be contributing to a systemic risk in the markets.
Yeah, that's exactly the right conclusion. I actually would qualify a couple of things that you said. First of all, the narrative that the passive investors and the active investors are ultimately the same, right? Together, they have to represent the aggregate of the market. We know that's not actually true. There's many stocks that aren't in indices, that aren't owned by index investors. We also know that there's many types of investments that aren't available. And when we talk about a passive allocation, we're really talking about all assets, including the corner grocery store owned by, a local entrepreneur. You have no access to that capital. You're ignoring that potential investment opportunity when you invest passively. I'm not suggesting that the local grocery store is a great investment opportunity, although someone clearly thought it was. The real issue that we face is that the government has actually increasingly changed the rules to automatically direct retail investors into passive vehicles. In 2006, we introduced a legislative reform called the Pension Protection Act that took the traditional 401k system from one that you had to opt into. You were given a job, you were then given the opportunity to participate in the 401k at your discretion. When you were hired, many people your audience is going to skew younger, but many older people can tell them when you were hired, you were offered a 401k, you were given a 401k package. That 401k package would typically have 1,000 different mutual funds for you to select from. It was up to you to make those choices. With the Pension Protection Act in 2006 shifting from an opt-in framework to an opt-out framework, you also had to decide what you were automatically going to default these new employees into. And we established something called a qualified default investment alternative. This is a vehicle that is largely liability protected for 401k sponsors, the company you work for. And you're automatically defaulted into an investment in those strategies. In 2006, tied to the language that you just used, that passive outperforms, that it's lower cost, et cetera, we actually decided to make passive investments those default 401k investments. In 2012, we changed it further to target date funds. Target date funds are almost always composed of passive indices, typically representing bonds, equities, international, domestic. And the only difference in your allocation is when you plan to retire. So basically, the only question that we are asking people about investing today is, how old are you? And based on that, we're then having them all invest in a very similar grouping of securities that have been blessed by their presence in an index.
And again, you're not speaking to what that means for performance. You're speaking to what that means for the market. And in the past, I've heard you talk about the consequence of this. It increases correlation between securities. It increases the valuation. It increases market concentration. It reduces the ability for new companies to come public. And it's like check, check, check in terms of the market that we're facing right now, particularly in the US. Basically, it's super concentrated in tech. Questions about whether we're in structurally higher valuation, if this is just like what we pay now for stocks. Why are we at record highs and still kind of a drip of IPOs?
Yeah, no, I think unfortunately the slide that you were quoting where I list the consequences of passive investing, that was written in 2017. It hasn't changed in nearly a decade. And unfortunately, all of those projections have come true.
And I think this is a great time to bring up, and I wonder, podcasts are great for storytelling. This all sounds great, and you can make these predictions, and we just don't know, is it going to come true? But you managed to make this an investable event, looking at one ETF in particular. And I'm wondering if you could tell us the story of XIV, which is now a failed ETF, that sort of is an example of a time where you put your money where your mouth is, and your predictions, which seemed wild at the time, came true.
Sure. So in the early stages of my analysis on this in 2017, I recognized that what was really happening was that we were not investing passively. And I actually want to add a clarification to that. The entire definition of passive investing, which is drawn from the language of Bill Sharp's 1991 paper, The Arithmetic of Active Management. And I encourage people to read it. It's actually a very accessible paper, but it's the source of all the material that you hear that active managers and passive managers in aggregate own the same things. And so the only difference is going to be fees. Sharp's articulation of what a passive investor was somebody who always holds every security. An active investor was simply one who is not passive. And the problem with that definition of holding a security is it means that you can't get in and you can't get out. There is no mechanism for you to enter the market or to exit the market under passive investing. Sharpe attempted to address this by proposing a theoretical, well, they trade in the liminal hours while the market is not open. So anytime the market is actually open, they're simply holding securities. Now, that can't happen. And so we actually know the entire framing of the problem is untrue. What is really happening is that we have a systematic algorithm by which we're investing that simply says, did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. That simple algorithm is really at the heart of what we call index or passive investing today. And I want to specify again, I'm looking for market cap weighted indices that are attempting to replicate the traditional passive exposure, not something that is, allocating to nuclear power reactors in a sector bet sort of thing. Those typically are not market cap weighted, by the way. They also represent a very active decision, even if you are outsourcing the individual security analysis. So having recognized that what we were dealing with was systematic algorithms and recognizing that the implications of my work suggested that these markets would become deeply unstable and virtually guaranteed to go to zero once a certain threshold was passed, I went in search of opportunities to express that. And I discovered the XIV, the inverse VIX ETF, which I'd actually used as a professional investor repeatedly as a mechanism for shorting volatility. It had done so very profitably. But as I began to do this work, I recognized that what we actually had here was a vehicle that had been crowded by retail investors who did not actually understand two of its characteristics. One was that it was forced to rebalance on a daily basis. That meant that every single day, based on the behavior of the underlying, I could predict almost exactly what their trading activity would be. The second feature was that this strategy had grown so large relative to its underlying that it had actually exceeded about 70% of the average daily trading volume was simply tied to this ETF structure. It was actually XIV and SVXY were two products that were tied to it. That had created conditions under which this strategy becomes so crowded that the need for the strategy to actually execute a trade of sufficient size and against a movement in the underlying would take the product, effectively clog up the order book, recreate the conditions of a crash of 87 or of 1929 in which orders were not able to be processed. The liquidity demands would exceed the thresholds and the price would ultimately crash. That was the simple analysis on it. There's a little bit more complicated component to it. This was actually an inverse product, which meant that it behaved in the opposite direction of its underlying, the VIX or the fear index, hence the XIV title associated with it. Perversely, that meant that the lower and lower VIX got, the higher and higher XIV rose. Most people interpret higher prices as a sign of strength. They also interpret a lower VIX as a sign of potential weakness. And just very quickly, if you're running a product that is inverse 100% to an underlying index, all that index has to do is double in order to send it to zero. And the VIX itself had gotten so low that the risk of it doubling had become extraordinarily high. That was the simple math behind it. Now, again, to complicate it further, the actual trade was expressed in options, which allowed me to have a limited risk investment. It wasn't like shorting the XIV and betting that I would get the timing exactly right. There were long-dated options in which, when I ran the calculations on the probability of an event that would actually cause the XIV to plunge to zero, it came to about 95%. And the options market was mispricing that. It was treating it as a traditional instrument in which the probability of something going from 120 to zero is impossibly low.
And correct me if I'm wrong, but did you give this presentation to the issuer or while the issuer was in the room?
Yeah, so I shared this presentation in May of 2017 at an equity derivatives conference in Las Vegas, which seems appropriate. And unbeknownst to me in the audience was the founder of the product, who proceeded to get into what I think is politely termed a discussion with me, in which he accused me of not understanding the product and not understanding the potential risks to it. And I challenged him. Did he think this would survive a crash of 1987? He believed it would. I, on the other hand, thought it would go to zero on a 4% decline in the S&P 500, a single day 4% decline in the S&P 500, and it went to zero on a 3.9% decline in the S&P 500. So either I'm overly conservative or very lucky.
So it did happen. It did come to fruition. You made it a tradable event. You've been making, as you said, these predictions for years. Now here we are, 2026. The trend has only exacerbated, right? There's more passive than there ever was. What should investors do about that? Is it an investable event, or is it a matter for policy?
Well, the challenge here is that ultimately, after that event, once I'd proven my point, I actually went to regulators as compared to the public. I did not go public with these concerns. Most of the awareness of the public component came through a combination of the publicity around the XIV trade and then subsequent speaking engagements, whether it's on podcasts, et cetera. And as this has become a bigger and bigger issue, and as people recognize that the markets are behaving more and more unusually relative to their history, more people have sought out my work to try to understand this component. The quick answer, unfortunately, is that because of the distortion that's occurring, the most effective and efficient way to invest is effectively do what everybody else is doing. You are riding a wave of inflows of cash that are hitting an inelastic market. This is a macro version of a micro trade, like a GameStop or a meme stock in terms of its behavior. We're seeing similar phenomenon in markets like silver right now, where a ton of money is trying to enter a relatively small market. In this case, it's a ton of money into a large market, but as passive share grows larger and larger, the distortive effects rise exponentially. So we're currently about 54% passive in US equity markets. That's far ahead of the rest of the world. There's only a few other markets that are similar to that, Korea being one, which has exploded in value in the past couple of years as people have reinvested in Korea. Another example of basically a camel trying to make it through the eye of a needle is kind of the right analogy here. We're about to release an academic paper that basically explores the outer limits of where this can be sustained. And the quick math is, in a world in which there are no structural flows, if you hit around 80 to 85% passive, you will automatically guarantee that you're going to have an XIV type event for the S&P 500. Now, that's a really scary difference because the XIV was a $2.5 billion fund that went to zero. It's a lot of money to lose, not in today's world, but that certainly felt like a lot of money at the time. Our profits off of that were significant. In this case, we're talking about the entire retirement system for the United States. We're talking about a $70 trillion market that could theoretically end up going to zero. Now, I don't actually expect that will happen, but I do expect that if the events that I forecast occur, the U.S. government will be forced into extraordinary measures, including most likely closing the market to prevent a bank run type event.
And sorry, what catalyzes this?
Actually, that's the interesting thing about the mathematics behind it. It becomes endogenous to the system. It's self-catalyzing at those levels. Basically, the smallest perturbation into a market that is that concentrated and passive would ultimately cause a volatility event that would then cause the crash that we're describing.
And the crash is because, again, just in simple terms, it's the reverse of everything that has been happening. Like right now, it's all fund flows because it's programmatic buying, if you will. And you're basically saying there's a point at which that reverses, and then there's not enough active buyers to step in?
Correct.
And we don't know the catalyst. But it's set up. It's set up that way that's a risk.
We actually know the catalyst. The catalyst is the growth and penetration of passive investment strategies. We don't know the precipitating event that will cause the actual crash. And again, I want to specify that model, which is a closed form mathematical solution, is based on no flows. If we have outflows, which we actually anticipate and are starting to see signs of, it can happen at a much earlier level. So I do actually think it is entering into the tradable regime framework. But that was one of the reasons why my XIV trade was, limited in size, was there was only so much I could actually do, and there was only so much time period in which I could actually express that trade with confidence. there happened to be 2-year options that were available that allowed me to articulate that 95% relative to the probability that was priced into the options. We're just now entering into a regime in which longer dated puts on the S&P 500 might become attractive in this context.
So that was going to be my next question. So it's something you're starting to think about as putting kind of an investable event around, but longer dated, similar to what you did in XIV. What does longer dated mean?
When something moves within 2-year windows, the options market tends to facilitate this type of trade.
And I guess at this point in the interview, I should mention, I didn't find Michael in sort of a basement somewhere. You've worked with Peter Thiel. You've worked at a hedge fund seeded by Soros. So you run in kind of these elite New York hedge fund circles, let's call it. And when you say this, what's their response?
I think most of them are increasingly aware of this risk. And we are all looking for, it has been very profitable to take the other side of the trade, which I want to emphasize I've encouraged people to do for years. The simple reality is this is a problem for policymakers. It's not a problem per se for an individual investor. There's nothing you can do to solve systemic events. Systemic events are non-hedgeable. They literally mean you cannot protect yourself against this type of event. So I want to be very, very clear. I don't encourage people to cash out of the market, to run away from this, et cetera. In fact, most of my work suggests that the greatest gains will be right ahead of the event. That was very much what happened with the XIV. And so you will feel like an idiot if this takes 2 years and you watch the S&P rise another 50 to 100% in response to these types of pressures.
I'm assuming that it's inexpensive to take on that put protection, those long-dated put protection right now.
It's, as I said, it's moving into the range of feasibility.
Now, one of the things that somebody might wonder is, okay, if the market has lost their nuance, how come, Meta is only up 2% over the last year and Google's up 75%? Doesn't that suggest that there's some discernment alive and well, more than some, that discernment is alive and well in the market? Because you would lump these two categories. We assume that they're getting programmatically bought at the same rate.
Well, they are being bought in proportion to their market capitalizations by the passive investors. And I want to emphasize that when we see the relative outperformance of Google, you mentioned it up 75%, or Meta up 2%, not all of that is passive. Google, there's actually been a significant rotation of active managers who are buying it, recognizing that the threat to search is largely being replaced by impending dominance in AI and LLMs. Those flows, though, those investments that are coming from active managers have a magnified impact. I just want you to stop and think about what you just said. Google is up 75%. One of the world's largest companies is up 75% in the last year, creating roughly $2 trillion in market capitalization. We existed for decades before the first company broke $1 trillion in market capitalization. That's actually within our living memory as investors, very much so.
Mm-hmm.
And so we've seen fantastic market gains and a rise in volatility around those market capitalizations that is a byproduct of an increasing fraction of the shares being held by passive investors. Once you're in, you do hold those shares. Do you sell based on it becoming overvalued? No. Do you buy because it is undervalued? No. You simply buy or sell based on your own life events. Do I have a job? Did I lose my job? Am I retiring? Right? Those decisions are completely independent of any information about Google, but your flows associated with it are impacting the price of Google. That means the information content in those flows is increasingly not tied to Google economics. When you have active investors change their mind, that causes higher volatility because they are now effectively trading in a lower float stock than is publicly disclosed.
Is there a way for retail investors to wrap their head around this? It sounds like flow information is kind of a great step to start and understand. I mean, you referenced what's going on in the gold and silver market. I wonder if you can use those as examples. And that's an area of investments. We're here in Canada. We got a ton of gold stocks, so it's an important sector for a bunch of investors. Can we use that sector as an example of how to think about this?
Yeah, gold roughly increases its available supply at about 2% a year. If you are going to increase investment in gold, as we have seen, by roughly 100% over the last year, that means you have to entice other people to sell. In order to entice them to sell, what do? You raise the price. Once the price is higher, then those people become reluctant to sell at that price. You have to raise the price to accommodate the next dollar going in. This is these are simple flow mechanics that you can easily wrap your head around. And I agree, something like gold is an easy market to think about because you have fixed supply relative to changes in demand. It has an inelasticity component to it. If those flows become very large in size, if China is redirecting trade surpluses into gold because it no longer feels comfortable buying U.S. treasuries after the Russian confiscation of their reserves, that's going to have a huge impact on gold. If China is joined by retail investors in the West who are drawn to the rising price and a narrative of a collapse of the value of the dollar or fiat currencies more broadly, then you will see prices rise even faster. And unfortunately, I think that's largely what's going on.
And do you expect that to continue? And I guess maybe before you answer that, how much time do you spend thinking about the market structure as a whole versus, the market's current obsession now is gold, US dollar collapsing, what's happening with tariffs, what's happening with inflation and rate cuts? Where is that on your list?
To me, they all blend together because ultimately my theories of markets are around flows. And so what I'm interested in is what is going to precipitate a change in flows. And so what I don't spend a lot of time doing these days, unfortunately, is evaluating single securities. Most of my work is truly macro in its construction. And that means that I spend much less time doing what I actually really love, which is digging into individual companies and trying to understand them. It's somewhat pointless in a world that is flow driven. Many of the theories around this, for example, in 1982, there was an academic paper written by Sandy Grossman, who was a professor of mine, and Joseph Stiglitz, the Grossman-Stiglitz paradox, which highlights the idea that markets can't become totally efficient because otherwise there would be no incentive for gathering information. In the absence of information, markets would become disconnected from fundamentals, and ultimately that should raise the opportunity set. The problem with that model is we assume that the information was all about the fundamentals of the company. And we just talked through the fact that as you move to passive investing, the information becomes tied to flows. Those flows are largely divorced from the individual economics.
This makes me think about, one of the consequences is you just get fewer companies that are willing to go public. And it's also happening at a time where there seems to be plenty of cash for private companies. We're going to have maybe $1 trillion IPO if OpenAI goes public because there's so much money willing to fund it privately. At the same time, and we've talked about this on past episodes, there's a retailification of the private markets. So I wonder, does the public market become not less important, but does there become kind of a new thing for everyday investors to get access to that get away from some of this systemic risk?
The quick answer is no. Right? A systemic risk is genuinely a systemic risk. It is non-diversifiable and non-hedgeable at a societal level. I just want to be very clear of that. So sure, there will be an individual out there that gets this trade exactly right and presents themselves as the next XIV guy, right? The simple reality is this becomes a much bigger problem on a societal framework. The really key thing to understand about all of those markets, you mentioned private, for example. Private markets are actually not flush with cash. They are starving for cash. They cannot get public. They cannot return capital to investors. There are more and more investors in the institutional framework who allocated significant funds into private equity and venture capital who are not receiving the liquidation events, meaning going public or being sold to another company, that is critical to the model in returning cash to those investors so they can invest in the next cycle of privatizations. The theory of private equity was largely about accumulating assets and then selling them to a more aggressive buyer once you had fixed them in some way or changed them. Unfortunately, that buyer was presumed to be public markets, and with valuations very high, you would anticipate that public markets would willingly embrace new IPOs that were coming from companies less aggressively priced. The problem is index investing influences you there as well, because a new company, a new entrant into the market in an IPO does not immediately become part of an index. There are some wrinkles around that we can talk about if we want to get really detailed. But for the most part, a new IPO has to be bought by active managers. Those active managers are losing assets and are afraid to deviate from their benchmarks. So unless the IPO is priced at an extraordinary discount or, to your point, draws in significant participation from retail traders, it's almost impossible to get a company public. You highlighted the retail traders and the retailification of it. I just want to emphasize that a big part of that growth has been a commission-free environment. We dropped commissions on equities, ETFs, and options. Typically, most investors have access to zero commission trading in ETFs and options at this point. And platforms like Robinhood, which have grown explosively, offer free commissions across all products. You have to recognize that the language of the internet applies here as well. If you're not paying for the service, you are the product. And actually, the single most valuable piece of research today is those Robinhood traders, that payment for order flow that allows Robinhood to offer free commissions means that Citadel pays between $2 and $4 billion every year to Robinhood, so they have transparency on those retail traders. Very, very profitable to have that information.
I think that's important to underline, and a lot of people don't consider the fact that that's why that stuff is free. So you still got a little bit of stock analysis in you, I can tell. You still like to get in the weeds there. One of your other big themes is around demographics, which people can think is like a little bit of a snooze, but you had this stat that smacked me in the face. In 15 years, half of the boomers will have passed on.
Yeah.
And that has massive implications, well, maybe for investing style, but for all of these other big themes that we talk about, like inflation, like commodities. I wonder if you could just run us through high level, like how you think about that.
Sure. So the core issue, demographics plays across everything. The famous management economist, Robert, Drucker, had the expression, the demographics of the future that has already happened. The simple reality is it's fairly easy to project that half of the boomers will be gone in 15 years because of mortality tables. We know what is ultimately going to happen to them. It's the same thing that happens on a healthcare adjusted basis to every generation. You eventually die. Chris Rock still has the single best horoscope forecast for anyone out there. Aquarius, you're going to die. Sagittarius, you're going to die. Gemini, which I am, you're going to die twice.
Yes.
So I consider myself somewhat blessed in that framework. This has huge implications because it does mean that there will be asset flows associated with it. It also means that there will be significant changes in the structure of our economy over the next 15 years that are going to be very temporal in their structure. We have to have assisted living facilities and nursing homes and the capacity to take care of rapidly aging parents and grandparents. That means we're going to have to build a whole bunch of stuff that hasn't already been built. The boomers are wealthier than generations that came before, so the nursing homes that they put their parents into are unacceptable. A nursing home you're typically going to occupy for about 14 months. Boomers are opting for assisted living facilities in which you typically occupy them for 24 months. That means we're going to need twice as many facilities as we otherwise would have if people were only in them for 12 months. We have not built those. We do not have the capacity to build those. The healthcare facilities that we have, the hospitals that exist in the United States were largely built to facilitate the birth of the boomers. We've had very little hospital investment since, and suddenly we need to take those maternity wards and turn them into extended care and geriatric care facilities. Investments that have not yet happened, that need to happen, or we will be dealing with shortages, and shortages are ultimately what cause prices to rise.
And so that filters into your view of kind of structurally higher inflation?
Well, what it means is that there will be inflation in areas that require physical infrastructure, and that's really different than what we've seen for the past couple of decades. In 2000, the United States acceded to most favored nation status with China. China joined the WTO. That created a huge production facility that effectively allowed U.S. manufacturers and many financial services firms, technology firms, consumer products firms, to outsource their production outside of the United States. That meant that much of the infrastructure that was built, for example, for making steel or aluminum, where you need significant inputs of electricity, those demands went away in the United States, replaced by that demand in China. This is part of the reason you saw such incredible infrastructure investment in places like China, is they were building the capacity to serve the world, not just China. Unfortunately, what that means is that the United States has coasted for about 25 years on excess capacity that was freed up through that behavior in areas like electricity, the electric grid, electricity production, power plants, nuclear facilities, et cetera. All of those are now facing shortages as well because of the growth, the emergence of alternative uses of the electricity, in particular things like data centers.
Now, I'm curious just about you and sort of your lifespan in money management. Were you always attracted to kind of the macro way of thinking? Was it something that evolved in your career? As I mentioned, you've worked with a lot of heavy hitters, Soros, Peter Thiel. Did they inform you and kind of how you approach the markets?
No. Well, yes, actually. Of course, they influenced me, and I've learned through time. I actually just saw a tweet that was put out highlighting a quote from Charlie Munger, who unfortunately has passed on, about Warren Buffett, saying, well, if Warren had not learned anything after Columbia when he was in Ben Graham's class, then he would have been very successful, but he wouldn't have been the person that we now know as Warren Buffett. And I think that's very true. I think we all come into the market with a particular bias or expectation. And over time, the market basically beats us up. And we learn that most of what we thought was wrong. I entered the market actually in a somewhat oblique way. I went to Wharton for undergrad, had experiences in financial markets, and actually recognized that I wanted to do was really understand companies. So I went into strategic management consulting, did advisory work largely around the purchase and sale of individual business units. And so a really detailed analysis of how businesses work, what were their profit centers, what were the profit potential for raising returns, lowering returns, et cetera, became critical to my approach. I actually then codified much of that insight into a software company that I built and sold along with a couple of partners in the mid-1990s. And with the sale of that company to Credit Suisse, I transitioned into the asset management side, initially very focused on the companies themselves. And so I became a small cap value investor in 1999. Recognizing that many of the companies that were in the small cap indices had become deeply undervalued relative to their potential. This was a byproduct of what I call passive 1.0, which was really the dot-com cycle. We can dig into the details of it, but there were structural changes of the indices introduced after the dot-com cycle that S&P didn't fully disclose the role that low float performance had created. That caused the dot-com bubble. Basically, people crowding into technology strategies, trying to buy stocks in proportion to their market capitalization. But the feature of the 1990s was you had low float companies because they were recent IPOs. And so those outperformed in the same way that we're seeing large companies outperform today. There is a mismatch between the liquidity that's actually available and the size of the orders that are coming in on a market cap basis. I was very fortunate. I'll be very straightforward with this. I was very fortunate that I entered the market in 1999 as a small cap value investor. If I'd entered it as a small cap value investor in 1997, there's a reasonable chance I wouldn't be here. And so I want to emphasize that luck absolutely plays a role. And so I was fortunate to be positioned in a seat that allowed me to take advantage of the dot-com crisis. That opened my eyes to some of this phenomenon, but it also introduced a very bad behavior, which is effectively assuming that I knew better than what people were expressing in the market. That was largely taken away from me in 2008. I had a relatively successful 2008. But what was really interesting about 2008 was that it introduced to me the idea of people being forced to transact by investor flows. And so the real criteria that caused what we think of as the global financial crisis in 2008 was when Lehman Brothers failed. It took all the cash that many hedge funds had and had held at Lehman Brothers International and turned it from cash into a long-term unsecured claim against a bankrupt company. That lack of cash caused massive amounts of selling to raise cash and potentially meet redemptions. The redemptions came in to create additional demand for that cash. And so prices had to collapse as a result of it. As I said, I was relatively fortunate in seeing aspects of this in advance and being able to navigate it. Again, I want to emphasize that a big chunk of this industry is just survival, right? If you are too chicken to take giant swinging trades and pursue trends, and you still manage to do okay, you can last a long time in this industry. But there's any number of peers I've had that have blown up along the way. And the reason they're not talking is because they've blown up. So my views changed radically in the 2008 phenomenon, and I recognized that there were two or three things coming out of that. One is that derivatives had become effectively toxic to hold on balance sheets. That actually skewed my expression of trades, seeking out derivative expressions of them, because the basis differential between the derivative and the actual underlying was often magnified to an extraordinary degree. I'll give a really simple example of that. In 2013, right, so this is give or take 4 years after the financial crisis, you could synthetically create 2-year investment grade paper in Hewlett Packard at give or take 12 to 13%, while the actual paper was trading at 4. Right, that's an incredibly profitable trade to be able to take advantage of that arbitrage, and it could only be done in the derivatives markets. And so the exposure to the derivatives markets and the emphasis on the derivatives markets has increasingly defined my career since. And I have become known largely for many of the trades that I express around the use of derivatives, things like the XIV, et cetera.
All right, this is great lead into some of the strategies that you do manage at Simplify. So let's get into some of your pro picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
Well, the fund that I manage directly is called CDX. It is a high yield fund. I'm very attracted to high yield for reasons that were articulated by one of my good friends, David Einhorn. In talking about my work, he emphasized that he was investing in companies that have endogenous return characteristics. In other words, he expects the companies themselves to buy back shares or pay dividends to allow him to meet his target return. He's not focused on relying on others to make the investment and buy the stock from him at a higher price. That is a change in strategy. David's traditional strategy would be to identify deeply undervalued securities. By virtue of him buying those deeply undervalued securities, that would attract others to bid up the price of those and normalize the price at a more rapid than normal rate, contributing to excess returns. He recognized that shrinking pool of active managers and shrinking pool of incremental flows into hedge funds meant that there was no more, cavalry coming to the rescue on those individual names. And so he refocused around that endogenous cash flow concept. I simply take that a step further and say, when you invest in high yield, you are actually investing in an asset class that has extraordinary endogenous cash flow. As a high yield investor, you typically receive between 25 and 30% of your fund in any given year paid back to you in the form of cash. That's a combination of the relatively high coupon that you're receiving, as well as the maturities of the individual securities that you own. A bond matures, you receive back the principal that allows you to make a subsequent investment decision into something else. That endogenous cash flow reduces the impact of passive strategies, but because high yield companies are riskier, there is an equity-like component that plays very well into my passive theories. I use that to largely construct a hedge for the high yield fund that protects me for the most part against widening credit spreads and does so at very little cost. So I'm actually able to protect my investors against drawdowns like we saw in March, April of this past year, while allowing them to participate in the higher coupon and income associated with high yield.
And you do that how? Because if you look at the chart, it's a little messy around that March, April time period. Like, explain what was going on there.
Yeah, so that's actually a really interesting time period. So first of all, my guess is you're looking at a price chart and not a total return chart.
That's right.
Okay, so one of the really critical things to understand is that we distribute about an 8.5% dividend on an annual basis. That's effectively passing through the returns associated with the hedge and the high yield. So for the price to be relatively flat is not indicative of the return of the portfolio. The second thing is, in that March, April time period, this fund was relatively illiquid. And unfortunately, we had an individual who attempted to buy the shares at the close without using a market limit order. They were picked off in the low liquidity environment. The market maker sold it to them at an 8% premium to NAV, which then subsequently corrected the next day. So that 8% end of day jump on April 8th and the subsequent decline on the next day when it traded back to NAV, net asset value, which is what you should be tracking your ETFs against, created roughly a quarter of all the volatility that my fund has experienced over the last year. So I was very angry with my market makers that occurred. That was a phone call that involved me not being nearly as polite as I am on this podcast.
Mr. Flow. So you know all about that. And so again, it's more of a for an investor that's looking for income, high yield, but stability, because sometimes you think about high yield, that comes with additional risks.
Yeah, and I think that's actually very true today. High yield is benefiting from the interest rate increases from the Federal Reserve that's raised the coupon that we're receiving. If we go back to 2020, the coupon on high yield would have been somewhere, 2019 to be more fair, the coupon on high yield would have been somewhere in the 4.5% range. Today, that number is closer to 8%. And so we've benefited from the increase in interest rates. And as the Fed is anticipated to cut interest rates, high yield should benefit from those interest rate cuts. The question becomes, why does the Fed cut interest rates? If the Fed cuts interest rates for economic reasons or distress reasons, then high yield has that equity-like exposure and unfortunately can experience what's called credit spread widening, or an increase in the riskiness of the individual bonds relative to government bonds. And that's really what I'm trying to protect investors against.
You've also brought two ETFs, the gold strategy one and the commodity strategy one. And before we explore both of those, I wonder if you could just give us your quick 30 seconds on your approach to commodities, because you've got kind of an easy to understand framework on commodities you're willing to go long and ones that you think are not worth it.
Well, I think the single most important thing for people to recognize is that on a global basis, we're seeing significant declines in population growth. The UN forecast for population that most people are familiar with anticipate, embed in their forecast an extraordinary increase in the fertility rates, recovery back towards historical norms. That means that the UN forecasts are actually wrong and have been wrong for a long time. They continue to downgrade them. There is a very high probability the global population is going to peak somewhere around 2035. When you think about commodities that service humans, commodities are typically consumed on a unit basis in what's called a pantry effect As an individual, you need X amount of steel, you need X amount of copper, you need X amount of gasoline, you need X amount of food. If the unit number of humans is not rising very much, I don't anticipate demand for those commodities to rise significantly. And at the same time, in many of those commodities, we're introducing extraordinary productivity investments. I know most of your audience is going to hear me say lab-grown meat and say, oh my God, that's disgusting. I would never eat that. Have you seen the list of ingredients? If you look at a Beyond Meat burger, for example, it will say it contains, lysophized acids and fats and pea protein and all sorts of stuff. Well, the simple reality is that's just our truth in labeling laws, right? It is beef. Mm-hmm. It is effective, and particularly when it is genetically grown beef, which we are moving rapidly towards, it literally will be beef. But it will have a list of ingredients that would roughly match what the list of ingredients if you put a cow through a separation process, you would effectively discover that the cow has a significant quantity of oats in it, and it has a significant quantity of cellulose, and that it has a significant quantity of fatty acids, and all those sorts of things that are listed on the Beyond Meats category. The reality is that it takes 16 units of grain to produce 1 unit of beef. When you move to a lab-grown system, it doesn't require anywhere near that. It becomes much more efficient at growing those proteins. And so not only are we not seeing the population grow, but we're actually seeing technologies emerge that further reduce the demand for many of those basic foodstuffs by eliminating animal husbandry or reducing animal husbandry. This is a long-term forecast. I want to be very, very clear on this, right? But it is a forecast within a reasonable amount of time. And we are actually seeing these components play through as the price of beef spikes in a post-COVID event environment. During COVID, if you remember, prices fell. And as a result, many farmers slaughtered their herds. It takes roughly 3 years to take a cow from calf to, from insemination to slaughter. And guess what? 3 years after the COVID trough, we're now seeing beef prices spike because we're discovering that there's a shortage of beef. That in turn is generating substitution. We've already seen pork prices collapse because that is roughly an 18-month cycle. Chicken prices collapsed in roughly 12 months. Egg prices are now collapsing because once you begin to replace the chickens and you decide not to slaughter them for a shortage of chicken for poultry, you discover that you've got egg laying capacity, right? So all of these things flow through in a definable time period that helps to explain much of the phenomenon that we're seeing, but it contributes, those high prices ultimately contribute to the adoption of substitutes, which in turn is ultimately destroying demand for commodities that I broadly group together as human food. That would include grains, that would include meats, that would include agricultural land, for example. Machine food, on the other hand, is exploding. And machines are unlike humans. Humans can get their energy from multiple diverse sources. We heat our homes with natural gas, and we heat ourselves through caloric intake, beef, pork, chicken, beans, vegetables, etc. Right? Lots of different things can contribute to our caloric intake. Machines need one thing: electricity. And so commodities associated with electricity production, to me, are a long-term structural buy.
And so is that expressed in the ETF that you guys run over there hard? Like those kind of hard, food is softs. I think you've made me a vegetarian after that conversation.
There you go. See, you've reduced demand.
There we go. It was that simple. Talk to me about that, the hard ETF, and whether that is a nice expression of what you're talking about.
Well, the benefit of hard is that ultimately it's not tied directly to the insights that I'm offering you. And so, among other things, understand that I'm offering a relatively long-term forecast, but it is influencing short-term markets. Hard is structured very similar to another one of our funds, CTA, which is much larger. CTA is a traditional managed futures strategy, effectively a trend-following type strategy, in which we basically stop questioning why are prices going higher. We simply ask, how sustainable does this appear? Does it match up against fundamental components? Things like those cycles that I talked about, a 36-month maturation cycle for beef, or 18 months for pork, or 12 months for chicken. It's actually even shorter for chicken. those factors are embedded in the model, and then we are simply following the prices in a trend following framework that removes the potential idiocy and overconfidence from Mike Green and puts it in the hand of a machine that is constantly reevaluating this and considering it across a basket of commodities in the case of hard commodities, interest rate exposures, and a few other components within CTA. Hard, the unique feature that we've added here is just that we have effectively forced the system to be long commodities. And so, if you have a fiduciary responsibility as a machine to be long commodities, just like passive investing, you are going to do it. But you're going to select the ones that are showing the most positive trends, characteristics, fundamentals, carry, which is a significant component associated with managed futures strategies and didn't really exist prior to the interest rate increases that we've seen from the Federal Reserve. All of those are factors that are playing into how hard is allocating its capital. And it does happen to express things often very similar to the way that I'm thinking about them.
I want to talk about your the gold strategy income ETF, YGLD. That one, we don't need to debate about it. That one has done extraordinary compared to gold bullion. Why? What is the extra layer that you add to it? How do you affect that income strategy? And because this ETF has only been around for a couple of years, how does it perform? Or how is it meant to perform in a downturn if we get a pullback?
So very quickly, YGLD is gold yield that's generated by selling call options on gold itself. And so in an environment in which gold is being bid up primarily by retail investors that are chasing levered expressions of that through options, that drives up the premium associated with those options and basically allows us to sell further out of the money options to generate the same yield or to generate higher yield by selling the same strike options. That allows us to monetize much of the move that's occurred in gold. And because it has been it's certainly been a dramatic advance, but relative to the implied volatility for gold, it's actually been a fairly favorable environment for selling those options. If there were a downturn that would occur, the return profile of YGLD would be cushioned relative to the return of gold because you are generating that income. Again, I want to encourage people, make sure when you're looking at any of these charts that you're looking at a total return expression as compared to a price expression. Because when you are paying out distributions, you're going to reduce that net asset value, and prices will ultimately reflect that net asset value, not the returns of the product.
Thank you so much, Michael, for sharing your time and your insights with us. I've certainly learned a lot. As I said, I'm probably vegetarian now, but I really appreciate it.
Well, that's why people go on shows like this, so that you can encourage people to flow into your trade. You're now going short human food and long electricity food or machine food. I appreciate it very much. This is really a pleasure. I enjoyed meeting you, and hopefully your audience wasn't totally turned off.
No, I don't think so. That's Michael Green of Simplify Asset Management joining us. Don't miss our next episode. We've got Jeff Elliott. He is the head of global equities at BMO Global Asset Management. We're going to talk about stocks that are outperforming around the world with a special tilt towards healthcare. That's coming out on Tuesday. We'll see you next time.